One of the best tax strategies that anyone can use is putting money inside of a brokerage or after-tax account and then utilizing a concept called tax loss harvesting. So kind of like the name sounds, you're going to be harvesting your losses or selling your stock options for a loss. And what that does is going to give you a chance to write off or offset future capital gains or even your income. So in today's video, I'm going to go a little bit more in depth on this concept and kind of how it works, so you guys get a better idea of it all. So if you are contemplating or already have money inside of these types of brokerage accounts, this is a strategy that you should be looking at each year, especially when we have big downturns in the market like we had in 2022. Now, just because the concept sounds good and a lot of people do this automatically, there are some cons to doing this type of strategy as well, which I'll also dig into. At the end of the day, it's always important to remember that any transaction we do is going to have some kind of tax impact on you. So it's important that before you do any type of strategy, before you hand off your money to some advisor to do this on your behalf, it's important that you guys are both sitting down together, reviewing your tax return and looking long-term on, is this the best option for me? How is it going to affect me in taxes both today, but also in 5 and 10 years down the road? So you want to come at it from a tax standpoint before just selling it off and looking at the short-term gains and losses here. Okay, so I got a whiteboard here. I'm going to be kind of walking us through so you get a visual idea of how this concept works. So when you're talking about tax loss harvesting, the idea or the strategy here is selling some of the stocks that have a depreciation value at a loss. So let's say you had invested in the company, we'll call it stock A in this example. And let's say when we bought stock A, it was worth $100, right? And then let's say throughout the year that it went down, came back up to here, right? So this is represented a whole year's time frame, and this is back to $100. Then nothing really happened, right? From a tax standpoint, we lost money, it came back. From a tax standpoint, nothing happened here, right? Now, tax law strategy is saying that, let's say the base or somewhere in this area, the stock was only worth $50 a share. What you could do is you could sell it right here for $50, and you would take a $50 loss, right? I bought it for 100, I sold it for 50, I just lost $50,000. So this is what we call, this is referred to as a loss in the portfolio. So when we sell it for a loss, this loss can actually be used to offset my taxable income as well as any other capital gains that I have. So you can kind of carry it forward from year to year. The most you can write off in a certain year is $3,000, but you can carry it forward over and over again. There's no limit currently on how many times you can keep carrying forward any losses you incurred. Now, a lot of people are kind of confused by this concept a lot of times because they're like, why would I want to sell things for a loss and then I lose on the upswing? Now, the smart way to play this is we sell it for a loss, and then you go ahead and you're going to buy something very similar. So there's something called the wash rule, which says when I sell stock A, I have to wait at least 30 days before I can repurchase it again. However, you can buy another company with that money. It just can't be the same stock. So I could sell stock A, go ahead and buy stock B. Now, stock B could be a very similar company. It often has one of the competitors, right? So usually similar product lineups, similar audience, things like that. So you could go ahead and buy stock B instead for $50, and you could write it back up. Now, from a tax standpoint, what did we do? We had a $50 loss that we can carry forward, and we had a $50 gain, right? So we're back $100. Right, so essentially your portfolio is the same as it was a year ago, but because we realized this loss and we didn't sell this gain yet, we can now write off $50 off of our income or sell off a different gain for that feature. So that's essentially kind of how this all works. Now, one thing to know about tax loss harvesting is it's not always a good idea for people. So for example, if you're going down this road, you have to realize that when I sell stock for a loss, I'm lowering my cost basis. Right? So cost basis is how much money you personally put in, right? So if I'm going back here with stock A and I put $100 in here, this would be my cost basis, right? But when I sell it and I buy stock B, and now this is my basis here at say $50, this is my basis. So what that means is when this eventually rises, and let's say stock B goes back up to $100, this $50 in gain that we realize is now taxable, right? So in these brokerage accounts, you have to pay taxes on your gains. Your base is how much money you put into it. The gains is what you owe taxes on, right? So when I do a tax loss harvest, I am lowering my basis. You can see here, I went from $100 basis down to 50, right? So yes, I got the benefit of writing it off, but when the markets swing back up, now I have to owe taxes on $50 of gains, when I sell it. So it's just something to realize, before doing the strategy, that you're still going to owe taxes on that gain of it. Now, when does this make sense? When doesn't it? If I know taxes are going to be lower when I do that, when I go eventually sell this gain that I'm getting, then it's going to make sense to do it. Remember, when we're dealing with individual stock accounts, they have their own tax system or tax brackets. They don't use the federal rates unless you're doing short term. Short term just means you're holding for less than a year. So if you hold in these positions for more than 1 year, you get special long-term tax brackets. So in 2023, for a married couple, they can make essentially $89,000, $89,250 to be exact, and still be in the 0% bracket. All right, so if you make less than $89,250 in 2023 as a married couple, you owe no taxes on any gains you get. So if this was this couple scenario here, they could actually sell it off here, pocket their $50 and pay no tax on that money because they're in that special tax rate. Now, what happens if you go over this income limit? Then it only bumps up to 15%. So it's still going to be less than the 22% bracket that couple would find themselves in. So historically, the long-term capital gains rates have been much better or more favorable than the federal rates. So this is just one idea of how you can be investing money to come off with lower taxes in the long run. It also allows for more flexibility because it's an individual account. You can essentially invest in any way you want it to be. You can access the money anytime, right? There's no rules like we have when we put money inside of a Roth or a 401k, where if we touch it before 50 and a half, we get penalized or anything like that. It's your money, kind of take it out, put money in anytime you want to. There's no income limits, no contribution limits. You can kind of do it however you want to do so. All right, so let's go through one more example here to make sure this makes sense. So let's say we had an investment. Let's say we threw $1,000 into it, and then it dropped, and now it's only worth $800 throughout the year. We could sell it for $800. So we'd sell it here. Right, we would realize a $200 loss. Right, so this would go in your tax return essentially as a $200 loss. We would take the $800 that we have left and we'd buy another stock. Remember, it can't be the same one, it has to be something different with $800. Now let's say it goes back up to $1,200, right? So that's a $400 gain we just got here. Now, if you said, hey, I'm going to sell out there and pocket my $400, you would take the $400 that you earned, right? Because that's a gain. Now we have to pay taxes on it, right? And you got to wait at least a year, obviously, for it to make the most sense. But if you did it, within a year, you got to pay, federal income taxes on it. But let's say you got $400 on it. You could use the $200 of loss to offset it. So $200 come off of here. So on that $400 gain, only 200 of it would be taxable, right? So you pay taxes on that, whether it be the long-term or the short-term rates. So it's just another way that using tax loss harvesting can help offset other gains you have in other investments, so you end up paying less money in taxes in the long run. Right? So if this person was in the 15% bracket, they'd only owe 15% on $200 instead of $400, so basically cutting their tax bill in half in this situation. All right, so if you found this video helpful, make sure to share it with a friend, hit the like button, and subscribe to show me future updates just like this one. I'll catch you guys all later. Remember that your future depends on what you do today.